Hi everyone. In this video, you will be learning about what is financial instrument and outline of IFRS 9. So let's get started. So IFRS 9 talks about accounting, that is recognition and measurement of financial instrument, impairment of financial instruments, and hedge accounting. So before we go to accounting, we must know what is a financial instrument. So as per IFRS 9, financial instrument is something which fulfill these four conditions. If any transaction has these four conditions, it must be categorized as a financial instrument. That asset must be recognized as a part of financial instrument. Okay, so what are these four conditions? That there must be a contract between two parties. There must be a contract between two parties. One is showing that as an asset, financial asset, and another must be showing it as liability. And their net settlement is in cash or equity. So if these four conditions are satisfied, one is contract. So one is contract. So contract can be a oral contract or a written contract. One is showing as financial asset, another is showing it as liability. So asset for one entity, liability for another entity, and settlement is in cash or equity. If these four conditions are satisfied, then that instrument that transaction will fall under the purview of financial instrument. Okay, let's see what is the official definition. So financial instrument is a contract. So what IFRS 9 says, financial instrument is a contract rise to financial asset of one entity and financial liability or equity instrument of another entity. So it is a contract, and as a result of that contract, one is showing a financial asset, another is showing a financial liability, or one has a certain right, a chain of contractual right, which result into receipt of cash or acquisition of equity, which result in receipt of cash or acquisition of equity, or one has some obligation which result into payment of cash or issue of equity. So again, a contract which result into that give rise to financial asset or financial liability which are settled through payment of cash or equity, or a right or obligation which result into payment of cash and equity. So these four conditions I can say that makes any transaction to fall under a purview of financial instrument. So let's see some example. There are trade receivables that you sold goods on credit. There are trade payables, you purchased goods on credit. You have bills basis on which you will be receiving some money. You have bills basis on which you will be paying some money. Are these financial instrument, the trade receivable, trade payables? Let's see. Let's see trade receivable. So you have a contract basis on which you sold the goods. You have contract between two parties. You sold goods on credit basis on that contract. and then you will be showing that as debtors. You have asset. Another entity must be showing it as liabilities, to which you have sold the goods, and ultimately that will be settled in cash after a certain period, right? So these four conditions are satisfied. So yes, 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 and yes. So answer to all four conditions are yes. So we can say this, all these are similar. You can check yourself, will fall under the purview of financial instrument. Let's see some more examples. You see, what we just covered is trade receivable, trade payables. What if you have advance received that you need to deliver the goods, or you have given advance to purchase the goods? Apparently, it might look like if the trade receivable is a financial instrument, so advance received or advance paid will be a financial instrument. Let's see. Is there any contract? Yes, we have a contract that we will be getting goods and we have paid certain amount of money. Yes, we have not received anything, so we will write in our balance sheet advance paid for goods, or if we have received advance, we will write it as our liability advance received for goods. Will that be settlement after a certain period? Will that asset advance received or liability advance paid will be settled in cash? No, you will be getting goods or you will be delivering goods. So there is a contract, asset for one, liability for one, but no. So if any of the condition is not satisfied, it will not be a financial instrument. So that advance received or advance given is not a financial instrument. So the answer is no. Let's see further. Loan receivable or loan payable. You have given a loan to certain person. So you have given a loan to certain person. So you will be showing it as loan receivable that you have given loan, and that person will be showing it as loan payable. So we have a contract that on these condition we have given loan. One person is showing us as loan receivable, another is showing as loan payable, asset for one and liability for another. How is it getting settled? Obviously in cash. Yes, 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 and yes. So this is a financial instrument. Absolutely yes. Let's move further. Convertible loan. What is convertible loan? You have uh, given a loan to certain ABC Limited. Okay, you have given a loan to ABC Limited. So you enter into contract that at this much of interest, I am giving you a loan. So that is your asset that you have given a loan. But how is that getting settled? Convertible. So when the term is over, you will be receiving a certain, like you have given a loan of 10,000. So you will receive 1,000 shares of face value 100 after the term of the loan, whatever be the term, let's say 5 years. So after 5 years, you'll be receiving 1,000 shares. So how is it settling? So it is settling in equity. So answer for this contract is yes, asset is there, liability is there, and it is settling in equity, yes. So convertible loan is nothing but financial instrument. Okay, let's see some more example. So for your premises, you need an electricity connection. You go to electricity company. That electricity company asks for deposit. They say that we will give you a meter, or we need some kind of security so that we are sure that there will be no bad debts of them. So they need a certain kind of security. Once you surrender your connection, you are you will be getting back your money. Okay, so there is a contract. Yes, you will be getting electricity. You have given the deposit. You will be showing it as your asset. They need to pay back the security after certain time when the connection is revoked. So yes, liability is there. Settlement is in cash. So yes, that security deposit is nothing but the financial instrument. Okay, let's move further. Prepaid expense. What is prepaid expense? Like I have an internet connection. I paid for 3 months. So in my books on balance sheet data, I will show it as my asset. Yes, I have paid money, but not received the services, so it's my asset. So it will be prepaid expense. There is a set that internet provider ISP will be showing it as their liability as they're yet to provide the services, and we have a contract uh, service agreement. So, but the question is, are that contract is settling into cash? Will after some time I'll be getting cash for that amount? No, they will providing me services and that asset will be over. So that prepaid expense does not fall under the purview of financial instrument. So the contract is there, asset is there, liability is there, but settlement is not in cash or equity. So one condition is not fulfilling. So we can say this is not a case of financial instrument. Let's see some more example. Investment in redeemable preference share. What is redeemable preference share? So the preference share after a certain time it will be converted into not that is convertible preference share which are redeemed after certain time that you will be getting money. It's nothing more. It is nothing more or less. You can say like debentures. Let's not go into the technicalities of what is redeemable preference shares. Let's focus on, is it a financial instrument? So let's check. Do we have a contract? Yes. So I invested in preference share of ABC Limited. So I've invested in preference share of ABC Limited. So that preference share is my asset. So in my balance sheet, I will show it as asset. ABC Limited will showing it as liability. So we have a contract that I have given certain amount of money and I will be getting that back after a certain period. So contract is there, asset is there, liability is there. Settlement, how it's getting settled, how this liability is going to settle. They will pay me the money. So settlement is in cash. So answer for all these are yes. So we can say this finance is also a financial instrument. So investment in redeemable preference share is also a financial instrument. And similarly, investment in debentures as well. So we have GST. So we have paid more GST. Take it as input tax credit, as if you don't understand input tax credit as GST refund. You need to take some refund from government, or you have paid, you have collected more GST from the customer. And you need to pay the GST to the customer. Income tax refund or advance. So you have made more income tax payment. You need to get the refund from the government, or you have paid advance tax. So any kind of tax you have paid, or you have liability, you have your obligation to pay the PF or ESI. So, so is that a financial instrument? Do you have a contract between you and government? Do you have a contract that you will be paying these amount of money? Okay, no, it is your statutory obligation. It is law of the land. There's no contract between two parties. It is your statutory obligation. So answer is no. So if answer is no, this is not a financial instrument. But let's see, other conditions are fulfilled. Yes, asset for one, like say income tax refund. So you need to take refund from the government. So it's your asset. Government must be showing in their balance sheet as its liability, and settlement is also in cash. Okay, let's move further. Retention money. For little example. So these all examples can be asked in exam or any kind of technical interview. So retention money. What is retention money? You have entered into a contract with a contractor, like build my house or build some furniture. So after he has provided the services, we block some amount. We don't make the 100% payment. We block some amount just to see if there is any, if there has been any defect and the things are not done as per the contract. So we block, let's say 10% of money for a certain amount of period to analyze if the things are done as we have prescribed. So let's see. So there's a contract, yes. Asset for one, yes. The contractor must be showing the amount he yet to receive is as his asset, and we have to pay that 10%. So it's our liability, and settlement is in cash. So yes, all these four conditions are fulfilled. So this is our financial instrument. Let's see. Lease receivable, sorry. Lease receivable or lease payable. Lease receivable or lease payable. You have given your building on lease and you're yet to get the your lease amount, lease payments, rent, you can say. So, do we have any contract? Yes. You're yet to receive money. Yes. You are showing it as your asset. That must lessee must be showing it as lease payable. So yes, settlement is in cash. Yes. So this is also a financial instrument. Let's move further. Financial guarantee. You have given a guarantee that you are given for guarantee for Mr. X. That if Mr. X doesn't make the payment, I will make the payment. So for whom you have given the guarantee must be showing you as his asset. Like if Mr. X fails, he will recover money for you. So you have a liability to pay. You have a contract of financial guarantee. Settlement is in cash. So financial guarantee is nothing but a financial instrument. Bank overdraft. Bank pays money on behalf of you. You have a contract with the bank for a certain amount of money. They will pay if your balance falls short. Bank must be showing bank overdraft as asset. You must be showing in your books as its liability, and finally it is getting settled in cash. Bank FD is similar, you understand. So it is also financial instrument. Call or put option. Call or put. What is a call option or what is a put option? Let me write a statement of a call option. So I buy a right to purchase shares of RIL at the rate of 2000 on 23rd of March 2021 by paying a premium of rupees 100. So I have purchased a right and I have this right. I have paid at 100 rupees that I have a right. So whosoever has sold the right is getting 100 rupees and I will be getting at this date RL shares at the rate of 2000. Okay, so this is a call option. So I be showing it as a set? Yes, if price is moving. So I have this right, I'll be showing it as my asset. Who has sold his the right must be showing it as his liability. Ultimately, on this date, either he will be settling in equity or he'll be settling in cash. Mostly it's settled in cash. So we have a contract. So put option is I enter into a contract of right to sell. Okay, let's move further. Interest rate swap. So you got it. So call put options are financial instrument. Interest rate swap. Interest rate swap is, let's write a statement of interest rate swap. I have a loan at the rate of 10% fixed rate. Fixed rate. So I have a loan of at the rate of 10%, that is a fixed rate. Okay. I enter into an agreement with Mr. X. I enter into an agreement with Mr. X that uh, we sorry that we exchange the interest rate or sorry so Mr. X has a loan of rupees 10,000. So we both have a loan of 10,000, but he has floating interest rate. I think I need I think that interest rate might decrease in future. So I think I should have a floating rate. And Mr. X wants to make a consistent payment. He doesn't want to take the risk of up and down between the interest rate. So we enter into an agreement that we exchange the fixed rate with the floating rate. I enter into agreement to exchange the fixed rate with the floating rate. Let's say both are 10% at this time. So if interest rate decrease to 9%, I am in a profit of 1%. So Mr. X will pay me 1% at the settlement date. If it increases by 1%, if it increases by 1%, I will make the payment to Mr. X. So there is a contract to exchange the interest rate, fixed rate with the floating rate. We will cover the detailed example of interest rate swap accounting with all the journals and all in the later videos. So it is just to understand if it is a financial instrument or not. So let's see. Contract is there. It is my asset for one entity and liability for another. How the interest rate moves. Settlement is in cash. So answer for all the condition is yes. So we can say it is the financial instrument. So last, what IFRS 9 says, cash and bank balance. Cash and bank balance are always financial instrument. It can also justify this full condition, but not to be in the controversy. This is treat always asset, cash and bank balance are financial instrument. So this is the definition of financial instrument, and I have covered in a detailed manner most of the cases what I can think of, or what has always been asked. So this is the definition of financial instrument. I think in next video we will be understanding, we will be learning the recognition and measurement part. So thank you so much. This is from my side. Let's meet in next video where we'll learn the recognition and measurement and other things. So thank you very much.